Welcome back. You tuned into Markets at Noon with me, Ankita Saxena, and with me is Kanishka Sarkar. And we are taking you through all that's happening in the market and how should you be invested. And to get us more perspective on that, we are now joined by Sanjay H. Parikh, who's the founder and CIO of Soham Asset Managers. Hi, Sanjay. Thank you so much for taking the time out and joining us. Sanjay, tell us about, how should one look at the markets right now? What should be one's investment strategy, given that, we were prepared for a rather muted return scenario in Indian markets this year around. It's not a surprise that we are looking at. But how should one park their investments? Because the commodities have done really well. Indian markets haven't done very well. But the next year has a lot of positive triggers, but there is still an overhang of FII selling and the tariffs.
Yeah, no, good afternoon to the whole team and the viewers. So basically, I think it is, you know, let's start with the balance sheets. So the balance sheets in India is still very, very strong. Household balance sheet, corporate balance sheet, banking balance sheet, even RBI, you've seen that there's space to provide more liquidity because the balance sheets permitted it. And the government balance sheet also this year, while it'll be a little tight, but by and large, we think they'll manage the fiscal deficit. Despite lower revenue because of GST and income tax, there will be some cost control, but not in the productive areas. So that's where, and the balance of payment also is fine. We have some rupee depreciation, which is fine, but otherwise, so the balance sheets are in good shape. The earnings have been slow. Last year onwards, the earnings have been consistently slow growth. And last year also, it was just almost flattish for Nifty. This year will grow at 10%. So this year maybe we'll end up at earnings of 1100 for 25-26. But we think that the downgrade cycle is bottom, and slowly and steadily the benefits of GST and income tax benefits and overall recovery, by and large, monsoons have been benign. We've seen some erratic, late rain and all of it, but generally we think there's no major disappointment. Inflation is in control. So nominal GDP, which is a very good lead for earnings growth, should slowly start getting better Q3 and Q4. And base also will be helping them because last year Q3 was quite weak. So with that, I think as we see slow earnings recovery, and then as we transit to 28, because from Jan, Feb, March, people will look at 26, 27, 27, 28, then we look reasonable on valuations. We're not as reasonable as yet. So we think markets, there is like buy on decline, and we stock selective, have a higher margin of safety, more so in middle small cap. That's our strategy.
All right, so that's the strategy, buy on decline and be stock selective. But Mr. Parekh, hi, this is Kanishka also joining in. I just wanted to understand, you said that, earnings recovery is likely on the cards now. So just wanted to understand any particular pocket that you're liking, because if we look up at your fund, your portfolio mix, you still have most of the allocation to large caps. That's more than 70%. So how are you viewing the mid and small cap space? What's the strategy there?
Yeah, so thank you. So essentially, our product is always, we positioned that always at least 70% will be large cap. So our benchmark is Nifty TRI. And on sectoral, we broadly, it's worked very well for us. At interim, there was some pain that we got. But otherwise, domestic overweight, global underweight has been the theme. Now, this is almost 3.5 years that we're running this fund, AIF fund. And and still the positioning is the same. So discretionary, which is auto ancillaries, we have, which has worked well for us. We are big overweight on telecom through Bharti and Indus Towers. Again, a few things that have happened is helping us there. Transportation, again, we have Adani Port, which has worked well. We are positive on electric utilities. Capital goods as a segment, we are positive. And we are underweight, big way in FMCG, we are zero. In oil and gas, some of the largest weight we don't own. We own, of course, HPCL, which we like. And then, we have some weight on real estate and financials for sure. We are neutral, but we're very positive and slowly and steadily, we will increase weight there as
Right, Sanjay, let's talk about what you just spoke about, that you have, you overweight on financials and other earnings of all the banks that have just come out. Earnings have been quite, let's say it has been quite optimistic as far as the banking pack is concerned. And going forward, if the next leg of rally has to happen, are the financials going to lead from the front? And also speaking of the fact that you are overweight on large caps, there is a lot of selling, FI selling on the large caps. So does the mid cap space, which has done well, better than at least the small caps, is there a value of comfort there? And what are the pockets that you would like perhaps in the mid cap space?
Yeah, so, the few questions you asked, I'll try and cover all of that. So one is financial. So financial, I think, we all knew beginning into the quarter that asset side repricing will happen faster than the liability side. And hence the NII growth will be quite weak. While the loan growth, if credit growth as a system is around 10%, loan growth has been 11, 12, 13% for different banks. And the NII growth has been weak because the NIMs are under pressure. So the good part is this was known. The other positive say the side is that there are some cost controls. They're investing in the right space, but the provisioning in terms of credit cost is certainly quite benign and better. So that's where the market I think is going to look through this weak quarter um, and look ahead. And I feel very strongly that if we may have one more rate cut, but maybe Q3 one more quarter and then Q4 onwards, the NIMs should bottom out. And hence, when next year when the credit growth picks up, the outlook for 27 with a clean balance sheet look far better for financials. So that's where we have a very strong view, and we would want to buy them. Of course, as I said, because of a weak Q2, we are tactically mild underweight, but we will increase our weight there. So that's on middle small cap. Generally, we have a strategy that keep a higher margin of safety, keep buy them at reasonable valuation, and then only look for them. And you can hunt harder, but have a filtering criteria which is stricter. And valuation is a very important parameter for us to enter in middle small cap, where the returns that we seek is far larger. So that's the way we are, and it's worked for us with our portfolio price earning on 27, 13 and a half times. On an overall basis, our ROE is 18%, and our growth rate is around 17%, which is much better than this.
All right.